You're listening to the Blood, Sweat, and Business podcast, featuring real business owners telling real stories about their real business experiences. Here are your hosts, John Chiappetta and Eric Jorn.
Welcome to another episode of Blood, Sweat, and Business. Today on the podcast, we have Andy Parrish from Alternative Tax Solutions. Welcome.
Welcome, Andy.
How's it going, guys? Thanks for having me.
Yeah, Happy New Year. What a way to ring in the new year, talking to us. We appreciate you coming on.
This is the first order of business. Well, yeah, it's been good. First order of business was a sale came in this morning, and then the next order of business was a podcast. So it's been a good day so far.
Love it. Love it. So tell us about the business. What do you guys do? How do you, you're involved in tax. We're involved in tax. Give us a little rundown about the differences between those two types of businesses.
Sure. So where Kaizen is, a CPA firm preparing 1040s and all the partnership and corporate returns, we kind of work in an adjacent field. We specialize in niche areas of the tax code that provide value to taxpayers, and we work with CPAs to help bring those strategies to clients. So mainly, we're talking about cost segregation, right, which is taking a building and then accelerating the depreciation life of various components that you're legally allowed to do. And then another big one that we do is called research and development tax credit. Okay, so these are tax credits that are applicable to a wide range of companies. Trick is knowing how to apply all of the law and governing authority surrounding that tax credit and the cost segregation to each specific case. So CPAs will bring us in when they say, hey, I have a client that's doing engineering. Let's take a look at this tax credit. Or I have a client that just purchased a new building. Let's take a look at cost segregation and see what that can do in terms of lowering the tax burden for the taxpayer. So we work every day. We're working with CPAs like you guys around the country doing projects like that. I think, Eric, we've worked on a few projects with your team. And yeah, it's kind of, we are doing tax work, but not the traditional, 1040, 1120 stuff. It's more specialty, which is fun.
Definitely. Yeah. And what's interesting is the relationship is, obviously we're on the front lines. We're working with that business owner on a regular basis where we have the opportunity to identify the opportunity for these strategies. And and that's where it's great that we have a relationship with another firm like yours that can execute on those that, we would require to have people specializing in a whole different avenue than what we do. And that's where we really value a relationship like this. Talk to us about why you guys went that direction versus a traditional CPA firm.
Yeah. So I'll kind of get into our origin story a little bit.
Perfect.
So we're a family business. Right now, my dad and two of my brothers are the partners. My dad's a majority partner and we're minority partners. My dad started the business over 15 years ago. So he, worked in technical sales like IBM, other telecommunication companies. And at some point, he got into cost segregation with one of the bigger providers of cost segregation in New England, where we're based out of. And so he learned that skill, and he also had a sales skill. So he was providing a lot of value to that company. And he actually met his business partner, who would become his business partner when he was doing a cost segregation. This guy, his name's Roland. He was the CFO of a large construction company. And so they had, become friends. And Roland is a CPA, MBA. He had the whole tax background, And so my dad was doing cost segregation. Roland knew about cost segregation. Roland had also just been through a large audit of research and development tax credit. And his company was using the biggest provider of these tax credits. Their name's out there, I won't mention it. But he didn't have a good experience. So this is around 2009, 2010. He said, I think I could do this myself. I've just gotten a deep dive of experience with this audit. And so he kind of put his CFO job aside and said that, partnered with my dad and said, let's go into the specialty tax consulting area. And, Roland, he had the construction expertise and the accounting expertise. So cost segregation was a good fit for him. Then he developed a knowledge base, both him and my father developed a knowledge base of research and development tax credits. And they started building that business full time in 2013. So I was in the military, then I finished up my undergraduate, and then I came into the business working full time. So I started doing mainly learning research and development tax credits under Roland at that time, and we built the business. It started off in my garage. My dad kind of took a risk and left that big cost segregation company, and it was a slog. I remember the first time we realized we were going to get $250,000 in sales. It was like a big deal. We put it up on the whiteboard at my parents' garage, and it's been fun to look back at that because we've been just up and up from there. And we've grown, and then I'm sure we'll get into this, but we've added other areas to our business. But what we do allows us to really become intimate with the taxpayer, just like you guys, right? So we can kind of see where they might need some other services, and we can see where they're at in their business life cycle, which kind of led us to incorporate more consulting practices as we made hires and as we grew. But the core of what we did started with cost segregation and research and development tax credit, right? And that's still that's the majority of our revenue from those two services. But it came from a guy, Roland, who had the Big Four experience and had the accounting experience, and then my father, who had the cost segregation experience and then the sales experience, biz dev experience, and then it kind of ballooned from there. COVID was tough. My dad's partner had a stroke. He got COVID. He had a stroke, a bunch of health issues. So we transitioned. We bought him out, and so that's kind of our org today. Is my dad is a majority partner, and me and my brothers are the minority partner.
Okay.
And so it kind of I hope that answers your question. We never were a traditional CPA firm, right? We kind of always just had these areas of expertise, and then built on that.
So you have a family business that you guys are running. Always, I think we talked about a lot in our podcast. There's always that family dynamic.
Yes.
How's that working for you guys, and what's the ups, what's the downs, pros and cons?
Yeah, that's a great question. There's a lot of ups. There's a lot of disagreements. There's probably a lot more disagreements than you'd have between non-related owners. But at the end of the day, that you can rely on each other, even if you're upset about something. You know that other person is going to do what's in the best interest of the business, because it's also in the best interest of our family. And my brothers and I, we all have young families, so no matter what disagreements we may have, at the end of the day, you can kind of rest easy knowing that there's not going to be some backstabbing or some duplicity that you might see from a non-related partner or a non-related team member. So that's good upside, and then get to work with our family. But one of the tough things is that I would say we sometimes take it too for granted that sometimes we don't act like this is a workplace. We act like it's our family living room sometimes, which, we keep that in check. We're also going through the generational transition. My dad is older, and, we have a good succession plan in place, I think, but there's speed bumps on that. My brothers and I were kind of like in the prime of our lives, right? And we have to, so finding the balance between, a partner with that senior wisdom who's on the back end of his career, and then, my brothers and I are kind of like on the uphill of our career. there can be friction if you don't manage that correctly, right? So finding how to manage that friction and finding balance as we go through this transition has also been a challenge.
Definitely. I think that's a normal challenge in any succession, in any business succession, right? Is you have somebody who they've essentially nearly or did already complete their career, right? And they're at the top of that wisdom chain. They understand, they've seen almost everything. But at that point in time, they stop looking at, what's coming in the door, what's the new that's happening. And then you and then you as the successor, it's your job. You need to be apprised of what's coming in the door. And that creates that conflict. And it's good, having it as part of the family, it's a good and a bad, exactly like you described. It's good on the side of you can just work through that, as a family group. And at the end of the day, it's not like I think you'll all have the same interest in mind and the same end goal in mind. Whereas, I guess, unrelated successors, right, they might have different, the win might be different for each of them. And that's where that can cause a little bit more struggle with it. So that family succession sometimes can be easier, but sometimes more complex. Yeah, and succession in general seems
and it's funny because...
Oh, go ahead.
It's funny because we'll get into this, but in our valuation work, a lot of what we're brought into is, gifting, right? And so we see companies that are managing succession plans. So we get to kind of see the do's and the don'ts of our clients that we're working with that are going through succession planning right now.
That's a great perspective to be able to have whenever you can experience it over and over again. And that's where we always feel we're very fortunate, and it always makes sense that the CPAs should be really good business advisors, because we get to see businesses that succeed, businesses that fail, businesses that success to somebody else, businesses that sell to a third party, that shut down. We see all these different scenarios, and experience is the best accumulation of knowledge.
Yeah, 100%. I think that's one thing that's cool about the field that we both work in, is you just get a lot of reps under your belt of seeing different businesses go through different trials and tribulations. And, if we're able to detach and say, hey, how does this actually apply to what we're doing? It's good because, not only do we have the experience of working on those projects where you see that, but we also can control our own ship, because we're owners. So we can incorporate the lessons learned into our own business planning. Kind of a unique position to be in.
So how do you guys execute your workload? Are you guys doing most of the work yourselves? Do you have people that you contract with, employees? What's kind of the way that you guys get your work done?
We have employees and we contract with folks as needed. We're a small company, 7 employees. So I handle the division of labor. I handle research and development tax credits. That's my area of expertise. My brother and my father handle cost segregation. So my father is that wealth of knowledge, and then my brother is he's more the execution. That's my brother James. My brother Sean, so he gets into a whole area of the business that we've evolved to. Okay, so he handles business valuation and strategic valuation. So that, and we haven't talked about that yet, but was an evolution that took place a couple of years ago. So he handles that, and then him and another employee of ours work on that, and then we have a few contractors and then a few other employees that are kind of project managers, heads down type folks.
Definitely. I think we got some opportunity. Most of our listeners are going to be business owners. There's really good topics that you guys address within your suite of services. I'd love to just kind of dive in and cover some of them. We'll start. I think cost segregation was your original bread and butter. Let's just dive into, what is cost segregation? What should a business owner think about to take advantage of this credit? Like, what are the things that they should know that when they go and execute on it, that, hey, it's time to talk to my CPA or contact you guys directly, and hey, let's execute a cost aggregation study?
Yeah, great question. So this is becoming an increasingly popular strategy as folks like Grant Cardone talk about it. But so more and more people know about it, especially rental owners, rental property owners. But for the business owner who is caught up in a million different other things, you're not thinking about your depreciation deduction and how to maximize it. Right? One of many things. So let's talk about what cost aggregation is a little bit. So when you purchase a building, you depreciate the building over 39 years, right, for commercial property. And so that means you get a little bit of recovery deduction every year for 39 years. What cost segregation allows you to do, and I won't get into the whole history of the law, but it essentially allows you to identify portions of that building that can be classified as personal property. They can be reclassified from real property to personal property, which means they can now be subject to accelerated depreciation life. So what you're essentially doing is going into that building and saying, okay, what components of this building can we reclassify, therefore accelerating their depreciation life, therefore accelerating the deductions that I'm going to get. The whole theory behind cost egg is a bird in the hand is better than two in the bush. So the government, the incentive is we'd rather have you have larger tax deductions now so that you have cash freed up so that you can make investments rather than recover having a little bit of deduction, over the next 39 years. So with cost segregation, and we'll talk about bonus depreciation, but with cost segregation, you're essentially front loading a large amount of deductions to try to lower your taxable income in the now, rather than lower it a little bit over a long period of time. Now, bonus depreciation comes into play here. That is essentially a law that says anything that you've identified in this building that can be reclassified into or less, so from 39 year to 15 year, you can bonus depreciate. And you guys know this all too well. But that means it was under Tax Cuts and Jobs Act that you could take 100% deduction in year one, right? So if you've got $1 million building and you find 15% of that, it can be reclassified. You get $150,000 deduction this year, okay, which lowers your taxable income. Bonus depreciation, as you guys know, has been phasing out. So one important thing for business owners to know is that if you have a building that you think you want to look at cost segregation, it's the time to act sooner rather than later. Because for tax year 2022, bonus depreciation is 80%. For 23, it's 60%, and it's going to step down 20% unless it gets fixed by Congress, which could very well happen here in the next few weeks. Another thing for business owners to know, you might be thinking, well, I purchased a building 5 years ago, too late for me to do this. As long as you have a decent amount of basis left in the building, I'd say $500,000 or more, you should look at cost segregation. So it doesn't matter if you purchased the building, 10 years ago. If you have a good amount of basis, you can do this cost segregation study and still get a tax benefit. There's all mechanics that you have to do, a 481 adjustment. We don't have to get into that. That's more for me, us and you guys, right?
Exactly.
Understand that. But there's definitely still benefit. There's definitely still benefit even if you purchased the building years ago. There's a few other things, but I'll pause here to see if you guys want to interject.
Well, I was just kind of thinking, a lot of business owners out there are maybe at that stage where they're buying real estate, putting a business in it. And I know you said that you could do it 5 years down the road too. And is it better to do it up front though, because they can get that deduction instead of waiting 5 years to get it if it's something that you're kind of thinking about doing? I don't know. I guess in my head, if I was buying real estate and we're going to put something in there, I mean, I guess I would want to do it up front. But if I don't know about it, I don't know about it. You don't know what you don't know. But I don't know. I was just kind of thinking, if you had your choice though in that particular situation, where would you go with that? If someone was maybe even just thinking about, hey, I want to do an investment property.
So one key thing, and this is going to get into tax mechanics. So I don't know how deep we should go, but you should only do this if you're planning on holding to the property for 5 years at least.
Okay.
Because as you guys know, there's depreciation recapture.
Yep.
And if you accelerate a bunch of depreciation and then sell the property 3 years later, you're going to be subject, a lot more of that capital gain is going to be subject to the personal tax rate because of depreciation recapture. So one key factor is, do I plan on holding this property for a long time? Now, for business owners, the answer is usually yes. Like my business is going to operate out of it. For rental owners, they need to ask that. They need to, to apply some more scrutiny to that question. Another thing is, a lot of people buy properties and then they say, I'm going to do a build out. Okay. So we get this question, I'm buying this property. I'm going to do a $500,000 build out. When should I do the cost segregation? Okay. And the answer for us is before you do the build out. And here's why. When you do cost segregation, you're going to come in and you're going to put a value on all the components of the building. Okay. So when you do that build out, you might tear down walls. You might replace drop ceiling. A lot of times, things that you demo, they can get stranded on the books, as we say. Now you have a value for that, and you can write off everything that you've demoed. So we usually recommend, if you bought a place and you're going to do renovations, you can do a cost seg before the renovations, and then we can do a cost segregation on the improvements as well. And that's usually fairly easy because we have detailed construction records of what's been created. So, those are two more helpful things for people to keep in mind as they're purchasing property.
That's great. That's great advice right there.
And John, I'll address maybe even the timing question of it too, at least from a tax planning standpoint, right? We want to utilize this when there's opportunity and valuable opportunity, right? So if I have a year where maybe my business is down, or I did an acquisition of another business and I bought the business and the real estate, inside that acquisition of the business, I'm already accelerating a bunch of depreciation because of the tangible assets that I purchased, right? I don't want to do a cost segregation in the same year and use accelerated depreciation against a, 12, even maybe the 22 or 24% tax bracket, right? You lose a lot of opportunity value there. So then you can park that, that cost seg opportunity, wait until you have a recovery year. Maybe you're at 500K plus of taxable income, and we're talking into the 35, 37 tax bracket. We do the cost segregation there, do the 481A adjustment, and handle it all in that current year. That's where I think you'll maximize the tax benefits. Maybe you might say, hey, I'll generate a net operating loss. We carry that forward to the next year. That could be another way to do it. And then opportunity also becomes, hey, is this, and I'm sure this is always a fun topic for you, is, where's that passive? Can we change this from passive activity losses into active business losses? Because that's always kind of the gotcha moment inside of real estate, inside of this cost segregation strategy, is if it's a passive activity, those losses can get locked up inside of the real estate world. But there's ways around it. You just need to have the opportunity to take advantage of that. And that's where you need to do, you need to have a team planning with you. You can't just do these things if you do these things in a silo, right? Maybe you're wasting deductions at 12%, at 22%, when really you should be doing it at 37% or greater. And you might not even be able to take them if, again, the holistic plan isn't there, right? You need to have that really group strategy on it to maximize the benefits.
Exactly. And then that's a group, we deal with that all the time. Is this going to be passive? Can I use this? Is it going to be a $25,000 deduction? And this is where you and I work together and say, hey, can we use something called grouping here?
Mm-hmm.
Because a lot of times, especially for business owners, they have the commercial real estate in a separate LLC. And so you are allowed to use a grouping election to take the losses from that real estate LLC to offset income from the operating LLC, as
Yeah.
long as you meet, one of 5 criteria, and it's up to us to determine, do they meet that criteria.
Definitely. Or, or maybe you have multiple rental, and this is where everybody's scenario really is different. Right. And, if I'm a business owner and I'm like, I have my operating business and I have my self rental property and that's all I have. And you're like, hey, why didn't we do a cost segregation study? I saw this on TikTok. Well, it probably won't be ultra beneficial to you at least at this moment, but maybe I got 5 rental properties. I got ones with income, ones with losses. Hey, that's a better opportunity. Or maybe I have a non-working spouse that can spend enough time working on all these rental properties, in which then we look at something like real estate professional status, which turns those losses into ordinary. We can offset that against your business income, especially if you have a really strong year. And that's where you get, that's how you get a home run hit essentially on a cost segregation study, is you get that real estate professional and you get the ordinary loss against ordinary income. That's the golden ticket with it. But a lot of things got to fall into place. But again, right, that's why you got to work with a good team of planners to really come up with this strategy. And then you got to use all that free cash. You need to do something smart with that free cash, right, John?
Absolutely. Maybe invested. I don't know.
John's a financial advisor, so he's got to always, he is the maximize the use of that money mindset.
Right, Eric, just about what you were saying. Again, this has become kind of a commoditized service, right? So a business owner will get contacted. Hey, I'll do a cost segregation for you for $2,500 or whatever. You got to be aware of what you're getting into, because, like you said, a lot of people see on TikTok, this is something I should be doing, and they don't realize that there's actually a lot more questions that need to be answered here. This guy's saying that he can do a cost segregation from his desk or from his living room of my property. You got to realize there's something called the IRS, and they actually care about deductions and making sure that you're doing things correctly. So, people got to be aware of what type of service level they're getting into, right? Because this stuff is more complex, as we're showing. We're just scratching the surface here, but it is more complex than one might be led to think.
Exactly. Yeah, that's what social media is for, right? It is to make very complex subjects that you really need to plan and strategize through into like, hey, everybody should do this, right? And that's how you get into trouble. R&D credits are really interesting. So I think a lot of people think of R&D credits as something that, you have to be like a research laboratory to get it. And, this is really scientific based business that you need to have. But in reality, any business can take an R&D credit. All it takes is innovation. Talk to us about R&D credits. And I know that's your specialty, so you could probably eat up the rest of the time that we have with that. But what should business owners think about, and especially not your standard obvious credit opportunities?
Great question. Business owners should think, just because when they hear the term R&D, they think somebody in a lab coat, right? In a lab. And the R&D tax credit is certainly for those types of companies, right? But it's not limited to those types of companies. In this world, there's something called the 4-part test, okay? So any business that can show that their activities pass the 4-part test can claim this tax credit. And what are we talking about? We're talking about a dollar for dollar tax credit, okay? So if I come in and say I found $1 million of R&D expenses in your company, that would get you about $100,000 tax credit, okay? So that is going to lower your taxes by $100,000. So that's what we're talking about. So what activities qualify? So I'll go through it real quick, because you could give a lecture on each of these of the 4 components. But 1, you have to be developing a business component. A business component is a product, it's a process, it's a software, it's a new technique or invention. It can also be something that you're working on under contract for somebody else. There's a lot of people don't realize that they may qualify for this because they're performing work under contract. But there's a whole avenue for contractors to claim this, okay? And in fact, there was a tax court opinion that just came out this year, or actually, sorry, 2023, which said, yes, somebody who's developing designs under contract for somebody can claim it. So test number 2, you have to show that there is uncertainty in what you're doing. It's called the uncertainty test. You have to show that you didn't know the solutions, you didn't know the designs, you didn't know how you should get to the end result when you started working on this. Okay. And again, I could go into depth there, but just uncertainty. Can I show that I was challenged in some way by this? Test number 3 is called the experimentation test. Okay. This requires that you show that you use a form of systematic trial and error to work on the project, right? So you have to show that you kind of formed an idea, came up with a way of designing and testing that idea, evaluated the result, and then moved forward or iterated on that idea. Generally, people who are following some sort of the scientific method in their process, and that can apply from anyone from a lab scientist to an architect working on a building. Right? If you can show that we defined the problem, here are our ideas for the problem, here's how we evaluated those ideas, and here are the results. That is experimentation under the tax code. What people should be aware of is if you are using any type of modeling software, if you're using any type of software to perform simulations on your design or your idea, then you can pass that test. The tax code literally says experimentation is a process that allows you to evaluate one or more alternative options through modeling, simulation, or systematic trial and error. So it's up to me to come in and see, are you going to meet that criteria, right? The 4th is called the technical in nature test. So everything that I just mentioned has to be associated with activities that are in the sciences, engineering, mathematics. It can't be for a bakery unless there's like some chemistry going on, And so that is sometimes where a lot of people hear, oh yeah, I do all that type of stuff, but it's in the arts or humanities, or it's in to develop some new like social science theory, right? And it can't be for any of that. So in general, what happens is people like you guys say, hey, I have a company that's an engineering firm, or they're building custom sheet metal for architects in the Chicagoland area, right? And I would come in and say, hey, do they meet these 4-part tests? And I can figure that out in a 20-minute conversation,
Mm-hmm.
And then we take them through the process of developing a proposal, and all of our proposals in the cost segregation realm too. It tells our clients a range of benefits that they could get from doing this, and then what our fixed fee is to do the work. We work under fixed fee basis. And then if they want to do the project, we go through the whole discovery process. And, generally by that point, we can tell if there's going to be something there, right? But so anyway, that, applying that 4-part test and then quantifying the cost and then documenting the cost is where the magic is, right? And
Yep.
This area of the tax code is expansive. It's got massive amounts of case history behind it. It's got, IRS memo. It's, the CFR behind this is very long. So you have to be able to discern what all that governing authority is saying for your specific company, right? And a couple things business owners should know is, again, this isn't like, cost seg is a little bit like, yes, this can be accelerated. No, this can't be accelerated.
Yep.
There is a lot of gray in this. There's not a lot of black and white tests in this R&D tax credit area. So taxpayers should be wary of anybody who's saying like, this is an easy peasy thing, and here, use our software and you can do it yourself. It requires some discernment and expertise in this area, and the IRS, they have certain opinions on what should be taken and what shouldn't be taken, and you have to be able to exercise your judgment of, okay, should we take this position? What do the tax courts say? What does the IRS say? Where are we likely to fall? And that's what my job is. And, the past 10 plus years of my life have been dedicated to this. And it's gone from, working with small companies to working with companies that are worth hundreds of millions of dollars. And defending these claims, to the appeals, the IRS and under audit and exam. So, I've been around the world with these tax credits, and there's some trends that have happened over the past couple years. One is the tax credit became a permanent part of the tax code in 2015 under the PATH Act.
Mm-hmm.
From there was like a rush of people to try to get into the field of R&D credit consulting, because they realized you could the biggest player in this field was taking a percentage of the savings. Okay, they were taking 25% of the tax credit. Wow. So you had venture capital say, they looked at that and said, whoa, let's get into that. So what I'm getting at is business owners have been bombarded by people telling them they should get an R&D tax credit. And it's led to people claiming R&D tax credits that really aren't eligible. Okay. And the IRS has not liked that. So they are specifically looking for people in specific industries claiming tax credit. So I would just say, if you're a business owner and you've been contacted by somebody, ask your CPA, because there's a lot of people that'll tell you everybody gets a tax credit, right? Because, they're just worried about signing you as a client. They're not so much worried about what happens if you get audited 3 years down the road. And, I guess I just spoke for a while, but, that's what the R&D credit is and kind of what business owners could think about when thinking.
Definitely. So say I'm let's just think of a common business. I'm an automotive repair facility, a large one. Maybe we're doing $5 million in revenue, or maybe I got multiple locations. What would they have an opportunity for an R&D credit, and what would those activities look like that they might be doing?
Yeah, so I would say that'd be tough for an automotive repair, unless they're straying outside the bounds of what they normally do.
Mm-hmm.
We had an automotive repair in Baltimore who wanted to get into boat engines. And this led to a whole, he set up a test lab of different things that you could do for boat engines. And he was trying essentially a technique for, modifying the boat engine. So I would say just your automotive shop that is doing your basic repair of cars, probably not much of an avenue unless they are really getting into kind of inventing a new technique or a new product, right? So that could be, hey, we contracted out with a CNC shop, paid them $100,000 to develop this new type of part for us. You can take that $100,000 as an R&D cost, right? So the everyday business that sometimes people get into projects that qualify that are different from what normal operations are. We had a Meineke, a guy who owned a bunch of Meinekes in Indiana, in the Indiana area, and he was being contacted saying you can get an R&D tax credit for, being a Meineke center, and I was like, I don't think that doesn't add up. But when I peeled back the layers, he had been developing a software so that he could integrate all of his businesses, right?
Mm-hmm.
So he hadn't even thought of that, and he was paying a contractor a good amount of money to develop the software. So we took an $11,000 R&D tax credit. So companies engage in activities that are kind of, they don't think of every day as like, hey, that would be R&D. But yeah, developing a new part, developing a software. Those are when you start to venture into those, areas. That's when you should start thinking about the tax credit.
We have clients that are putting together different websites and different processes behind those. I would assume something like that might even qualify.
It's worth a conversation, right? That's the big thing is if you're venturing into the dark on something that's new for you, if you're pioneering, right? I guess maybe that's the best way, or innovating. You think of anything that you're doing as pioneering and innovating, hey, let's have a conversation about it. And like you said in a 15 to 20 minute phone call, you could probably make a determination whether or not it's worth pursuing. And that's kind of the key, is just awareness, right? Think about the activities you're doing, and let's just have a conversation about it. And I mean, a dollar for dollar tax, I don't think people really understand how valuable that is. That essentially 3x your cost on value, right? Instead of getting just a tax deduction, you're getting a tax credit for dollar. That's huge value there.
Yeah, right. And people do confuse deduction with credit, right? Which is common. We're talking about tax credits in Congress right now, and they're trying to fix some stuff with bonus depreciation and R&D expenses, and they don't even know the difference between them. The lawmakers. So,
yep. But they're going to
fix
it.
Very common problem that people.
Yeah, they just write the law, and then we find a way to fix it and make it applicable to the things that are actually happening in the world and how tax code actually works. Talk to us about other services that you guys are doing for small business owners that they should be thinking about.
A couple of years ago, we started adding more services. One of them is business valuation. Okay, so my brother Sean he has all of those acronyms, which I don't remember, but so he's very experienced in business valuation. He comes from the corporate finance world. And that's, business valuation is a very straightforward service.
Mm-hmm.
You either need it or you don't, generally. And you guys know when a business needs value. If they're doing, there's numerous reasons that are, I'm blanking off the top of my head here, but you pretty much know when you need a valuation. Divorce, buying out a partner. But an area that we've moved into that we really think provides a lot of value for business owners is what we call strategic valuation. So this was kind of born out of the fact that when we do these research and development tax credit studies, we develop long-term relationships with these business owners, just like you guys do. And because every year we're going in and saying, hey, what's going on? What have you been up to? I'm looking at the P&L. And so I can kind of tell if the business is going into another stage of its life cycle very soon. You have an older partner, younger partner is going to want to buy them out. Hey, they're going to want to be selling here. And so this allowed us to kind of say, hey, we have a certain skill set that can help you as a small business owner prepare to survive the due diligence process that you're going to be put through when you go to sell your company, okay? And that skill set comes from being the people that get brought in to value a company, right? So we know exactly where you're going to get hammered on your value. So, a lot of small businesses, and I'm sure you guys see this, right? They think they're going to sell for a certain amount of money, and it never happens. They end up having to settle. In fact, according to SBA statistics, I think it's like 93% of small business owners end up never selling when they want to. And only 3% of those who do are happy with the price. And that's mainly because small businesses can get hammered on what's called company-specific risk. Okay, so anybody who knows anything about buying and selling companies, you'll have heard of discounted cash flow. Okay, so that's a model that you build out to see what's the present value of all the future cash flows of the company that I want. In that calculation, there's something called weighted average cost of capital. Won't get too far into this, but part of that and that percent that weighted average cost of capital is a percentage that gets multiplied against your value, to come up with the enterprise value.
Mm-hmm.
The higher that percentage is, the lower you're going to get from a buyer. Okay, so they've essentially, when they raise that percentage, that's them saying, I am not paying as much as you want for your business.
Yep.
So the reason this happens to small businesses is because there's a component of that cost of capital that will eventually become what's called company-specific risk. Because these small businesses don't have publicly traded stock, you can't calculate what the equity is worth of a small business, right? So that's where you have to come up with a the valuator has to come up with their own determination. And if they come into a business and they see that any one of what we call the 8 core pillars of a business are not in line, they can say, oh, that's company specific risk. Common ones are the owner has all of the knowledge up in their head and it's not penetrated down to the organization. Okay, that's a key man problem. I'm disking you because we're going to have to overcome that. Hey, this company they're relying very heavily on one contract with or 2 or 3 contracts with a few customers. Okay, that's company specific risk. And anything down to, hey, your HR policies are not aligned with your legal policies. So, to make a long story short, our company comes in and says, hey, if a professional valuator comes in, this is where they're going to hammer your value. Here's what you can do to prevent that from happening. So we give them identify what somebody would pay for you right now, but also identify what the intrinsic value of this company is, and then how you can unlock that intrinsic value and then improve it. So we call this strategic valuation. I mean, it really doesn't cost much more than a regular valuation, but you're getting much more value. So we use our expertise in combination with a software that we license, which was developed by a partner of ours. And it's pretty cool because we can show you, how moving a certain, improving a certain area of your business will literally move the value of your company up. Okay. So, we're going through a big transition in our country right now. You have the baby boomer generation, which is the biggest generation, and they own a lot of small businesses.
Mm-hmm.
And they are looking to transition to the next stage of their life. And there's not a big Gen X coming up behind them to buy up these businesses, which would be the normal life cycle, right? You sell to the next generation.
Yep.
So what's happening is, these small business owners are having to sell upstream, right? So a big strategic buyer or a multinational, somebody who's done multiple transactions in their lifetime, right? And for a lot of small business owners, they've done 1 or 2 transactions. So they're selling to a nuanced buyer.
Mm-hmm.
And, all we're saying is, hey, we can give you the tools to provide what that nuanced buyer is going to ask with your value intent.
Yeah, I mean, it is hard for a small business owner when they're say working with a PE group that's doing roll-ups and they're doing these acquisitions one after the next. They have an acquisition team, and you have a small business owner, and inside that due diligence battle, right, it's easy to get outclassed and kind of beat up because you don't have the resources. You don't think about things like, are my HR policies in line with my legal strategy? You don't think about all those little nuances and aspects of being, being an enterprise, right?
I'd even say that there's a lot of businesses that don't have an HR policy. They don't have, a legal policy, and those types of things. Maybe before you start putting your company on the block, you might start thinking about somebody that could help you, mitigate some of those down, or those cons that might lower the value of your company,
Totally. If I'm a small business owner and I'm thinking about exiting, how far out from my planned exit date should I be thinking of even looking at a strategic valuation?
Ideally 3 to 5 years. But that's, as you guys know, that's not always going to be the case.
Yep.
Deals pop up all the time.
LOI, a letter of intent. Somebody's going to get a letter of intent and say, hey, let's do this due diligence process. And it's not too late, even if you've gotten an LOI, right? But obviously, the further you start, the better. Because in 3 years, the first request, let me see 3 years of P&L, right? 3 years of tax returns. So in 3 years, you can build the trends that you want to build, okay?
Mm-hmm.
But, a lot of what we're talking about is what John said, just creating an HR policy. That doesn't have to be like this enormous exercise for a small business. Just proving to somebody that you have, like, the most common one we see is all the knowledge that in the owner's head. It's not penetrated down to the business. Just putting processes and procedures in place, that can go a long way to show, hey, I can, because as an owner, you want to be able to show I can leave and you've got this turnkey operation. Therefore, you should pay me a lot of money for it, So that stuff can be done, it can be done, but the sooner you start doing it, the better. But 3 to 5 years is generally in the business what we recommend.
Definitely. And I think that's such a valuable service. I think it's very, very smart of you guys to pivot into that arena, just from the standard business valuation realm. Very smart.
Yeah. Yeah. Thank you.
Definitely. All right. Well, I think we just covered 3 really big, interesting subjects that I think all small business owners should be thinking about. Any last thoughts or concerns that you think a business owner should have on top of their mind when they're thinking about, hey, how do I maximize the results of my business?
Taking the 15 or 20 minutes or even a couple hours a year to talk with your tax planner and to talk with people like us can go a long way. Business owners have 100 things to do, and it's all about where can I spend my time that produces the most value. And I know writing ISO policies, that is important, right? ISO policies, but sitting down with your tax preparer and consultants like us can help go a long way and uncover value and opportunity that you didn't think existed in your business. So, it doesn't hurt to get on a 20-minute call. It doesn't hurt to sit down for an hour meeting to try to, to plan for how to best, one, maximize your tax picture, but also to see, hey, how do we financially plan for the future? How do we tax plan for the future? Those conversations can pay off in a big way for a business owner.
Totally. Andy, thanks for your time. We really appreciate it. Business owners, listeners, think about all the things that we discussed today. We'll carve out some of these individual nuances and give you little highlights of them, just so you can really hone in on them. If they want to learn more about alternative tax solutions, how can they find you guys?
Yeah, so our website is alternatetaxsolutions.com. So alternatetaxsolutions.com. And yeah, we've got pretty good resources there. Got some videos. We're not too active on social media. We probably should be a little bit more. Or they connect with me on LinkedIn. Andrew Parrish. And if you look up that, it would be Andrew Parrish, Alternate Tax Solutions in Rhode Island. So
awesome. We'll make sure to post all that information in the show notes as well. Thanks again for your time.
Appreciate it.
Yeah.
You have been listening to the Blood, Sweat, and Business podcast. You can hear more real stories from real business owners about what it takes to make it in business by subscribing to the podcast on Apple Podcasts or Spotify. If you like what you hear, leave a review and a 5-star rating. This podcast has been brought to you by Kaizen CPAs and Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com.